Right now, the market is stretched in the sense that it is quite aggressively pricing in rate cuts. We still see positive earnings yield of around 2% above bonds. So equities are still favored. That being said, there's not much margin there if the Fed does not cut as aggressively as the market is pricing in. What we're looking for in terms of earnings for our clients and for our portfolios is signs that the lower rates are actually seeping into the real economy and into earnings, not simply driving flows or optimism. So I think that's where we're actually looking a lot closer at earnings outside of big tech. We're looking at names and looking for businesses and business segments that are growing, that are differentiated. Signs that that this lower cost of capital is actually creating some sort of multiple expansion.
Or at least the anticipated lower cost of capital in the absence of Fed actually beginning with the rate cuts. Speaking of earnings, we've had already a bunch of earnings come out this week. Tesla last week disappointing, overnight somewhat of a disappointing reaction to Microsoft and Alphabet. Is this great run for big tech coming to an end?
No, I don't think it's coming to an end. I just think that the expectations are extremely lofty. I mean, these companies really carried the weight of the market over the last 12 to 14 months. And I mean, these companies are delivering fantastic earnings. The issue is the expectation. We're so used to earnings trouncing expectations that if they come slightly in line or slightly above or slightly below in the case of Alphabet, the market punishes these companies mercilessly. But I mean, one of the things that we saw on Microsoft yesterday was their cloud computing revenue was very strong. They had, going back to my earlier point, they had some segments which grew very strongly, which were exciting for us, like their Xbox services and content revenue was up 62%, which shows us that the Activision pickup is working well for the business. That's exciting, right? That's the sign of a company that's healthy, diversified, and growing. The market is really reacting to Alphabet's miss on ad revenue. It barely missed. So we think that the market will stabilize. This should not derail the recovery, so to say. And we're looking eagerly at other sectors. We were excited by seeing some positive news in communications, industrials, throughout this month. And you can see even with some of the financials and bank earnings that the market reacted negatively at first, and since then has really found its footing.